The moment the announcement broke, it sent a shockwave that reverberated through Washington and across global financial markets. Canada had just delivered an $850 billion trade shock that left the White House scrambling to respond. What had once been a steady, predictable economic partnership between two of the world's closest allies suddenly transformed into a high-stakes confrontation with consequences that could ripple across industries, currencies, and governments. Inside government offices, emergency meetings were convened. On Wall Street, traders watched screens flicker as uncertainty gripped the markets. Across industries reliant on cross-border trade, executives immediately began calculating what this massive disruption could mean for the future of their companies, their employees, and their bottom lines. The scale of the situation was staggering. $850 billion tied to trade flows, supply chains, energy agreements, and corporate investments now hung in the balance. The move was swift, precise, and impossible to ignore. For Donald Trump and his economic team, the pressure was immediate, a test of both strategy and instinct. For Canada, the announcement was a demonstration of the leverage it could exercise in a world where economic influence is increasingly a form of power. Analysts quickly reached for words like unprecedented, escalation, and economic shock. Investors scrambled to gauge exposure. Currency markets reacted with volatility as traders weighed the implications of a sudden disruption to one of America's most critical trade relationships. In Ottawa, officials stood firm, signaling that this was no temporary maneuver, no mere negotiating tactic, but a decisive shift in strategy. The message was clear. The era of predictable trade assumptions was over. At the heart of this confrontation was a sweeping economic action directly impacting multiple industries across North America: manufacturing, natural resources, technology partnerships, and consumer goods. All of these sectors, pillars of the U.S. Canada economic relationship, were suddenly in flux. Billions of dollars flow across the border daily, sustaining jobs and stabilizing markets. The sudden disruption was not just a policy change. It was a structural shock. Inside the White House, advisors scrambled to assess options. Reports described a sense of urgency as officials explored countermeasures and diplomatic channels. Trump, known for his aggressive trade approach, faced the challenge of responding decisively without escalating tensions further. Respond too aggressively, and the confrontation could spiral. Respond too cautiously, and the United States might appear weak. The balancing act was delicate, the stakes enormous. Financial markets reflected that uncertainty immediately. Major indexes showed volatility as investors reacted to the news. Companies deeply embedded in cross-border supply chains saw their shares fluctuate. Energy firms monitored potential disruptions to exports and imports, while manufacturing giants spanning both nations reviewed contingency plans. The interconnected nature of modern trade meant that no major sector was entirely insulated from the shock. Currency traders reacted with rapid adjustments. The Canadian dollar fluctuated sharply before stabilizing, and the U.S. dollar faced pressure from the sudden uncertainty. Commodity markets were sensitive as well, particularly energy and agricultural products that depend on stable North American trade flows. Corporate leaders faced an immediate challenge: clarity. Many companies rely on long-term contracts and predictable regulatory environments to plan operations and investment. The sudden $850 billion shock created a cloud of uncertainty, raising questions about delaying expansions, seeking alternative markets, or bracing for new tariffs and regulatory changes. Boardroom discussions quickly focused on the question of adaptation. The political narrative surrounding the move intensified rapidly. Supporters of Canada's decision framed it as a necessary assertion of economic independence and strategic leverage. Critics in Washington described it as an aggressive action threatening stability and mutual prosperity. Media outlets dissected motives, actions, and potential outcomes, fueling public debate on the future of the bilateral relationship. Behind the scenes, diplomatic channels were active. Negotiators explored potential paths toward de-escalation, balancing domestic political considerations with the broader need for economic stability. The challenge lay in finding a resolution that could satisfy both governments without triggering further market turmoil. Global markets watched with growing concern. The United States and Canada share one of the largest trading relationships in the world. Any disruption of this magnitude carries implications far beyond North America. European and Asian markets monitor developments closely, aware that instability between these two countries could influence global trade flows and investor confidence. International institutions began assessing potential ripple effects on economic growth forecasts. American workers employed in industries tied to Canadian trade were immediately affected. Jobs in manufacturing, energy, agriculture, and logistics rely heavily on stable cross-border commerce. If companies face increased costs or reduced market access, employment decisions could follow, affecting communities built around export-driven industries. Canadian businesses also confronted uncertainty. While the move showcased economic leverage, it carried potential risks. Escalating tensions with the United States could provoke retaliatory measures, potentially affecting exports and investment. Business leaders in Canada emphasized careful navigation to preserve long-term stability, even as they pursued short-term strategic advantage. Investors focused on duration. Temporary measures produce short-lived volatility. Structural shifts have the potential to alter market dynamics for years. Analysts debated whether the $850 billion shock represented a negotiating tactic or a fundamental realignment of economic priorities. Technology companies were particularly attentive. Cross-border data flows, digital services, and technology partnerships form a rapidly expanding segment of trade. Regulatory changes affecting these areas could reshape competition and investment patterns. Firms with integrated operations across North America began evaluating vulnerabilities and contingency strategies. Energy markets remained central. The U.S. and Canada share extensive energy infrastructure, from pipelines to electricity grids. These systems are designed for efficiency and mutual benefit, but they also create interdependence. Any disruption in policy or trade conditions could influence pricing, supply expectations, and investment plans. Traders closely monitored developments, anticipating potential shifts in supply dynamics. Public reaction evolved as details emerged. Some saw Canada's action as a bold assertion of leverage in a complex global economy. Others worried about escalating trade conflicts and the impact on consumers and businesses. In the United States, political leaders debated responses that balanced strength with the need for economic stability. Media coverage intensified with continuous updates, expert analysis, and commentary. Social media amplified every rumor and statement, creating heightened attention and speculation. The $850 billion trade shock became one of the most closely followed economic stories of the moment. Timing was critical for the White House. Swift action could reassure markets and demonstrate leadership. Delays could prolong uncertainty and amplify volatility. Advisors weighed options carefully, considering both immediate reactions and long-term strategy. Every decision carried consequences extending far beyond the current moment. International partners watched closely. Many countries maintained trade ties with both the U.S. and Canada. A prolonged conflict could influence global supply chains and investment flows, with governments quietly preparing for potential shifts or new opportunities. The broader economic context added complexity. Markets were already navigating inflation, interest rate adjustments, and geopolitical tensions. The sudden introduction of a major North American trade shock heightened sensitivity, prompting caution among investors and companies alike. Forecasts were adjusted, new variables incorporated, and contingency plans updated. Despite the tension, opportunities for resolution remained. Trade disputes often involve negotiation and compromise. Both nations have strong incentives to preserve an economic relationship that has delivered decades of growth and stability. Finding common ground requires diplomacy and strategic flexibility, where public posturing must eventually give way to substantive dialogue. As hours turned into days, attention focused on signals from both governments. Every statement, every market movement, and every corporate adjustment was analyzed for clues about intent, potential concessions, and the trajectory of the relationship. The outcome would shape not only the immediate future of the $850 billion trade framework, but also the broader course of U.S. Canada relations. What began as a single announcement evolved into a defining moment for North American trade. Canada's decision demonstrated the power of economic leverage in an interconnected world. The White House's response would indicate how the United States plans to navigate such challenges in the future. For businesses, investors, and citizens, the stakes could not be higher. In a global economy built on interdependence, stability is often taken for granted until it is disrupted. This confrontation is a reminder that even the strongest partnerships face moments of intense strain, and the responses of leaders in these moments determine whether tension results in transformation, escalation, or renewed cooperation. As the situation continues to unfold, one fact remains clear. The ripple effects of this $850 billion trade shock will be felt far beyond Washington and Ottawa. Markets, industries, and governments around the world will watch closely, aware that decisions made today could redefine economic relationships in an era of increasing uncertainty. The stakes are immense, the consequences global, and the lessons enduring. As the hours turned into days, the tension between Washington and Ottawa has not abated. If anything, it has deepened. The $850 billion trade shock remains a central concern for markets, corporations, and governments alike, a reminder that even the most seemingly stable relationships are vulnerable to sudden disruption. The decisions made in the coming days will determine whether this confrontation leads to resolution, escalation, or a prolonged period of uncertainty. The United States and Canada, partners for decades, now find themselves navigating a delicate balance between national priorities and shared economic interdependence. Optimistic observers envision a rapid de-escalation, where diplomacy prevails and negotiators find common ground. In this scenario, Canada might adjust certain restrictions while maintaining its broader objectives, and American corporations could accept compliance measures in exchange for renewed market access. Markets would stabilize, investor confidence would return, and companies could resume long-term planning with less anxiety. A compromise would reinforce the notion that economic partnerships, even under pressure, can endure and even strengthen when tested. A less forgiving scenario involves escalation. Should Washington respond aggressively with retaliatory measures, trade disputes could expand beyond the initial restrictions, affecting multiple sectors from energy to agriculture to technology. Supply chains could experience bottlenecks, investment decisions might be delayed, and profits could be impacted. The human cost would be felt in employment decisions, wage adjustments, and community stability, particularly in regions reliant on cross-border commerce. The economic consequences would extend far beyond North America as investors and policymakers worldwide adjust to new risk calculations. There is also the possibility of a slow burn scenario, one in which negotiations drag on over months. Partial concessions, regulatory tweaks, and ongoing uncertainty would keep markets cautious and investors hesitant. Companies might adopt a wait-and-see approach, delaying expansions or reallocating resources to risk management. While immediate catastrophe might be avoided, prolonged ambiguity can itself be a destabilizing force, slowing innovation, altering market dynamics, and reshaping competitive landscapes. The global implications of this confrontation cannot be overstated. The United States and Canada serve as a model of integrated, cross-border economic cooperation. If tensions escalate, it may encourage other nations to pursue protectionist policies, reduce reliance on foreign partners, or reconsider their approach to trade integration. International investors, already sensitive to geopolitical risk, are recalibrating portfolios and reassessing exposure. Commodity, energy, and currency markets remain especially reactive to shifts in expectations about trade flows and supply stability. For workers, the human dimension is immediate. Jobs in manufacturing, logistics, energy, and agriculture all depend on stable trade. Any disruption affects hiring, wages, and job security. Communities built around export-driven industries are monitoring developments closely. Canadian consumers may notice price shifts, reduced availability, or subtle changes in service as companies adjust to new regulation. Domestic businesses may find opportunities to expand and capture market share, but the broader uncertainty requires caution and careful strategy. At the center of this confrontation lies a larger question about globalization and economic integration. For decades, open markets and cross-border cooperation were assumed to be universally beneficial. Recent years have seen a recalibration of priorities, with nations increasingly seeking strategic autonomy, protecting domestic industries, and reducing reliance on foreign partners. Canada's move reflects this broader trend, demonstrating that even long-standing allies can exercise leverage when interests diverge. Financial institutions, trade specialists, and corporate strategists remain in constant motion. Banks evaluate exposure to cross-border transactions, insurance companies reassess risk models, and trade finance experts revise contingency plans. The interconnectedness of modern commerce means that a shock in one sector can ripple through many others. Even companies not directly affected by the restrictions are sensitive to the signals being sent as uncertainty influences investment sentiment, consumer confidence, and market volatility. Amid the tension, opportunities for innovation emerge. Canadian companies competing with American brands may expand into new markets, and entrepreneurs may introduce products tailored to shifting consumer demand. Economic disruption often creates space for adaptation and growth, though it also carries risk. Stability and predictability are prized in trade, and sudden regulatory changes test the resilience of both governments and corporations. The choices of political leadership in both countries will define the narrative. Will diplomacy prevail, producing compromise and stability, or will a cycle of retaliation take hold, potentially escalating tensions for years? The outcome will shape expectations for future trade disputes, influence investor confidence, and affect the perception of economic power and cooperation on the global stage. Canada's decision has exposed the fragility of even the closest economic partnerships. It has forced governments, companies, and citizens to rethink assumptions about market access, leverage, and strategic interests. The era of unquestioned cross-border integration is being challenged by national priorities, and the handling of this crisis will serve as a blueprint for how similar disputes are managed in the future. For companies, investors, and policymakers, the $850 billion trade shock is a defining moment. It is a test of resilience, adaptability, and strategic foresight. Decisions taken now will reverberate far beyond North America, shaping supply chains, investment strategies, and perceptions of economic reliability for years to come. Whether the result is renewed cooperation, cautious compromise, or prolonged tension, the world is watching closely, learning lessons about leverage, interdependence, and the balance of power in global commerce. Ultimately, this confrontation is more than a dispute over trade or regulation. It is a moment that underscores the complexity of modern economic interdependence and the stakes of leadership in an interconnected world. The ripple effects will be felt in markets, industries, and communities worldwide. Stability can no longer be assumed. It must be actively managed. How leaders navigate this moment will determine whether tension leads to transformation, escalation, or a path toward renewed collaboration. As this story continues to unfold, one thing is certain. The consequences of this $850 billion trade shock will be enduring. Markets will watch, industries will adapt, and governments will make decisions that could reshape the framework of international trade. For viewers, investors, and citizens alike, the lesson is clear. Economic interdependence is powerful, but it is also fragile, and moments of disruption, however brief, have the potential to define the future of global commerce in profound ways.